Back to QAV, the US Edition, Episode 3. It is currently the 29th of April, 2025. My name is Cameron Riley. With me, coming from his palatial golf hut in Victoria, Tony Kynaston. How are you, TK?
I'm good, Cam. How are you?
Good. We just did an hour talking about the Australian market. Now we're going to talk about the US market. What
Far
can you
more
say
interesting.
about the US market? Well, yeah, look, it's still crazy times. Bit crazier over there than it is here. You've been paying a little bit of attention in the last week. Do you have any insights on what's going on in the US market, Tony?
Well, I think we just sneaked this show out now because the market was up last night.
Yeah.
Before people lose their minds again when it goes down again with something going on over there. As I said before in the Australian show, we're about to go to the polls here in an election, and the market couldn't care less, whereas everything is intently focused on reading the White House tea leaves in the US market.
Yeah. Well, the US market, both the Dow Jones and the S&P 500 are sort of up this week, as is the Australian market, for reasons that aren't very clear. I mean, nothing has really changed. I mean, the Trump administration seems to be pulling back a little bit on the tough tariff talk and claiming that the Chinese have reached out to them. Chinese are like, no, we haven't.
It wasn't us.
Yeah. But I don't know, the market seems to be a little bit more optimistic over there. It's almost not quite back to where it was before the tariff announcements, but it's certainly getting back up towards there. Yeah, Liberation Day. But of course, as our long-time listeners would know from the Australian side of things, we don't really pay that much attention to what's going on in the market. It doesn't really affect our investing strategy much at all. It just means that sometimes we sell more than other times. But really, we're just looking at individual companies, either the stocks in our portfolio and looking to see whether or not they breach one of our selling triggers. And if they do, we sell them, and then we see what there is to buy based on our checklist, the framework that you've developed over the last 30 odd years. And as I guess an indication of that, I can talk about our portfolio, because I did start a US portfolio a little bit over a year ago, and it's doing okay. It's picked up a little bit. All time, so I started it in September 2023. It's currently tracking at around 53% return over that time, versus the S&P 500 about 24% over that time. At one point, before the US presidential elections, it was up around 100%, our portfolio. So Trump has managed to halve our portfolio in whatever that is, 6 months since the election.
Halve the CAGR anyway, yeah.
But if I look at the last sort of month, we're down about 3% in the last 30 days. The S&P 500 is down about 1% over that same period of time. So I've had to sell a few things. I've struggled buying things over there too recently, and this week I bought something and then sold it immediately. Like a day later, and I'll tell you that story when I get to do my pulled pork, my deep dive in a minute. Do you have anything you want to share before I get into my deep dive of the US market, Tony? Do you want to talk about the analysis stuff?
Yeah, I did. The only thing I've got to share is the data dump you gave me on the weekend of the differences between US and stocks and the way that market works, and the Australian stocks and the way our market works. And I thought it might be worthwhile just racing through a summary of that. it'll probably be of interest to the Australian listeners who are listening to this, but it's going to be, I guess, illuminating for the US listeners to understand where we come from, and that we've just taken the Australian checklist and used it on American stocks, and it seems to be working well, but we may modify it over time once we get more experience investing in the US. I think the basic difference that you highlighted was the accounting standards are slightly different. So in America, they follow the US GAAP standard, the General Accounting Rules standard, and we follow the international one called the IFRS standards. And overall, they're probably fairly similar. I mean, they all have balance sheets and P&L statements and cash flow statements. So at a general level, they're the same. Some things which are different are how things are accounted for, like research and development. So they're treated differently under both accounting standards. US tends to capitalize, or has to capitalize. US companies have to capitalize their research. Has to expense their research. Australians have the option of capitalizing it. So that'll just mean that Australian balance sheets might have slightly more intangible assets, and US profit and losses might be depleted by any research going on. It hasn't really been an issue in the Australian market because we don't do a lot of research, primary research in Australia. We're basically financial and mining sectors heavy in Australia, which again is a difference with the US. So there are a few biotech stocks. There's one big one, CSL, which does some research too, so it affects them. But overall, it doesn't, how much a company spends on research and where it's accounted for doesn't play a big part in our investment decisions in Australia.
And particularly for us, value investing, the biotech stocks are either have no cash flow because they're just hype and research and we don't go near them, or they have found something and they're hyped out of the stratosphere, and their price to operating cash flow is ridiculous and we won't even look at it. So they don't really end up on our buy list a lot.
Yeah. So a lot of these differences are, I guess, are nuances, and you're right. If it's if there is a difference, it may not appear on our checklist anyway, because we're value investing, and a lot of the companies that this will apply to are in the tech space or the biotech space, and they have high PE ratios. Bit of a difference in the way you account for inventory in the US versus Australia. Again, there'll be some differences which I'm not going to worry too much about. They are different. I don't think there'll be a big impact on the checklist. US companies have to use first in, first out to value their inventory. Australia has an option of doing that, but they often use last in, first out. So there'll be differences to their asset valuations and their P&Ls because of that. US has quarterly reporting, which is a big difference to Australia, where we have half-yearly reporting. To make up for that, Australia has a continuous disclosure regime. So if you're a board of an Australian listed company and you think that something's happened which, if it was known, would materially affect the share price, you have to disclose it. Now, that doesn't apply in the US, although there are similar rules, but basically companies, because they're reporting 4 times a year, will generally wait for a quarterly announcement and then wrap up any sort of market moving statements with that. And there is also, of course, as we found out recently, our regulator, which is the company called the ASX, who runs the market here, has, I think, taken their eye off the ball a bit with continuous disclosure. So there have been a couple of surprises we wouldn't have expected to see in the past that have come out during our half-yearly reporting seasons. So there's that difference. Another difference in Australia is it's a little bit more individual shareholder friendly. So America allows dual stock holdings or dual classes of shares. So you can have the Murdochs with preferential shares or the owners of Alphabet with preferential shares. Controlling the voting in the company, even though they don't control by majority the number of shares in the company. In Australia, that's not allowed. So you have one share, you have one vote. So that's the difference. What else? There's a couple of other issues with regards to shareholder activism. I think it's fair to say the US has a legacy or a history of shareholder activism, which isn't seen as much in Australia. There are shareholder activists here, but they don't. They tend to work behind the scenes a lot more, engage with the board or engage with large shareholdings. That I think that's probably a legacy of our superannuation system, where there's a lot of large institutional holdings which take stakes in Australian companies, and therefore you've got to kind of appeal to them if you're an activist taking a stake to convince them that you should all band together to change management. And then generally you trot off and see management and convince them to make a change because you've got a large holding in the company. We still do have class action lawsuits here, which they do in the US as well, so that's similar. We separate the role of chairman of the board compared to CEO, and that's a little bit different in the US, where you have a lot more executive chairmans than you do in Australia. So you can do it in Australia, but tends to be in smaller companies, just to kind of save on costs, I guess. Employ a chairman and a chief executive officer. But generally, the governance principles in Australia is the board is meant to be overseeing the management, and that can be a little bit blurred in the US. And then, there are obviously differences in the liquidity and the size of the US market versus the Australian market. So it'll be interesting to see how it goes for us as value investors. A lot of the companies we look at in Australia don't get much analyst coverage because the market is focused on liquidity and focused on the top end of the Australian market, whereas in the US, liquidity goes a lot deeper. And so you can get coverage all the way down to companies. And what would be a medium cap company in Australia is probably classed as a small cap company in the US anyway. And therefore gets coverage. So small caps get more coverage in the US because they are larger than they are in Australia. So all those things may be an issue for us, but it hasn't affected our dummy portfolio to date. So I'm not sure how that will play out in our investing with US stocks. But probably one of the biggest differences between the US and Australia in terms of how the companies operate and how investors focus on them is Australia has the franking credit system, so dividend imputation. And if US listeners don't know what that is, because you don't have it in the US, basically it's a double taxation regime. So in Australia, when a company pays their corporate tax on their profits and then distributes a dividend, the end recipient of that dividend doesn't then pay tax again on that dividend. And I know there is a few rules about that in the US as well. So some dividends that get paid do get taxed preferentially, but in Australia, you get either a rebate for the tax the company's paid, or if your personal situation is you don't pay as much tax in a percentage basis as the company does, then you get a rebate from the government for the tax that's already been paid. So you get money back in your account. So that has meant over the years, coupled with our superannuation industry, again, which is different to the US. If I can quickly summarise, in Australia, by law, a salaried worker or an employee will get 11% taken out of their earnings and put aside into compulsory superannuation funds. You can set up your own fund and run it yourself and invest yourself. But probably the vast majority of workers will use the superannuation industry, which is it's broken up into for-profit and not-for-profit sectors. But they then have large resources which are pooled towards the retirement incomes of companies. It was set up to reduce welfare payments to retirees by the way of the pension. So there are some good things about the system, but what it's meant is that Australian companies do pay a lot more dividends than American companies. One, again, to help retirees fund their retirements via superannuation, but also to take advantage of the franking credits, which are payable in Australia but not in the US. US companies tend to do a lot more share buybacks. So similar sort of thinking, I guess, is how do we return profits we don't need to reinvest in the company for growth? We can either pay it off as a dividend back to our shareholders, or we can buy back the shares, which will mean earnings per share goes up, and therefore that will benefit the shareholders that remain in a similar sort of way to paying them a dividend. There are two schools of thought that says one's better than the other, but basically both share markets have done the same sorts of returns. If you look at 100 years sort of performance of them, there's a sort of, they're both doing about 10%. There's kind of a 1% difference. I think the ASX has come out in front, and analysis suggests that's probably because of the franking credits, but really I think it's line ball over the years. So that's, in a nutshell, the differences between the ASX and the US stock markets.
And out of that, on first glance, Tony, is there anything that you think we need to tweak in our checklist to accommodate any of those differences?
Nothing comes to mind. And it reminds me of the times in Australia when the accounting standards have changed. I think the most recent example was the treatment of leases. So again, they moved from one style of accounting for them to another style, which had an impact on balance sheets and P&Ls. And everyone said, well, we had a question asked, should we change our checklist because it affects operating cash flow? And it didn't really affect it. You know, it may have bumped something up 1 point on the checklist or down 1 point on the checklist, but it wasn't a big difference. And as you've outlined with your portfolio performance report, our investing to date in the US, which has been going for how long? 12 months, 18 months?
18 months, roughly.
18 months. Yeah, I haven't seen anything to adjust in the checklist so far.
All right. Well, thank you for that. We'll keep an eye on it. And I guess one of the things about our checklist is it is flexible. We can modify things as we need to, but so far it seems to be working quite well as is, and we don't want to mess with it unless we have to. So one of the things that we do on our episodes usually is what we call a pulled pork. It's a deep dive. You know, if you haven't come across our stuff before, generally speaking, QAV as an investing system tends to avoid getting too deep into what a company does or what a sector is involved in. One of the great things about the system, as Tony developed it over the years, is that we let the numbers do the talking. We look at the fundamentals of the company, how much money they're making, whether or not they're making more money, they're generating more cash flow year after year after year, the quality of management, the quality of the business, how well the business is performing. And then, so it's the quality side of it. The value side of it is, can we buy it can we buy it at a discount to what we think a fair valuation of the company would be on a per share basis? So it doesn't really require us to get too deeply analytical about a particular business or a particular company. That said, it is fun to open up the doors of one of these companies that we're looking at and learn a little bit about them, because we're curious. Who are these guys? What do they do? What kind of business is this? Not really because it's part of our standard investing methodology, but I like learning about the businesses just when you do the pulled pork in our Australian show each week, because it's an opportunity to learn something about a sector, what people are doing and why businesses are doing well. So we tend to pick a business that's on a buy list. Maybe we've added it to the portfolio recently, and we ask ourselves the question, who are these people and what do they do? So I was going to do SKM today as my pulled pork, which is SK Telecom, major telecoms company in South Korea that happens to be listed on the New York Stock Exchange. I added them to our US portfolio over the weekend because I did a buy list on Friday, Saturday, and was looking for stuff to add. This was one of the stocks that looked good when I did the numbers. However, when I went to do the pulled pork on them last night, I saw that over the weekend, Monday in South Korea, before the market opened in the US, they had come out and said there had been a massive data breach of their entire network, and all 23 million of their customers' details had been breached, and their share price had fallen 7% in the Korean stock exchange. But this is before the US markets had opened. And so I jumped in and I sold them before the US market opened. And they did go down 8% today when last time I looked in trading in the New York Stock Exchange. Now, it's not one of our normal sell triggers, but they were at the same price as they were when I bought them. So I was like, I'm out at 5,000, and I got in and out and put in my sell order and got out. So before it went through. So back that one out before it happened, basically.
Well, that's prescient because it has fallen below its sell price for us to sell using the breadloader.
Really? Yeah. I don't think it was very high above it in the first place when I bought it. Yeah. But I know it dropped quite a bit today. I checked it just before we went to air. So the other stock that I added is the one I'm going to do. It's DAC. DAC is Danaos Corporation. It's another shipping company. I think our first episode or second episode, we did Zim, big Israeli shipping company. Our US portfolio has a lot of shipping companies and financial services companies on it. And as we've explained in other episodes, that's not through design, but we do find different times that our portfolios tend to be weighted in this sector or that sector just because those sectors tend to be undervalued for some particular reason. We were in shipping pre-Trump and his tariffs. There's been a lot of obvious problems in global supply chains over the last few years, COVID, Ukraine war, et cetera, stuff happening in the Red Sea. And there's now more things happening with tariffs throwing a spanner into global supply chains and what the future of them holds. But again, we don't forecast. Part of our system is we don't forecast what the future holds. We look at the numbers as they are today. And I think it's a great quote. Can't remember which one of the great. It might have been Peter Lynch. Somebody like that said, he who invests with a crystal ball ends up eating broken glass, or something like that.
Yeah.
We do not try and predict the future. We just look at what seems to be value today. And the way I've always understood it, if they're a well-run business, they're probably going to do a pretty good job of navigating the waters, the economic waters as they move forwards. We're putting our faith in them. If they've been running the business well in the recent years, we only look at the last few years, but if they've been running it well, they should, have a good chance of running it well into the future. So anyway, Danaos. Now, they own a bunch of container ships. They're based out of Greece, I should say, first of all. Not Israel this time, Greece, but listed on the New York Stock Exchange. They own a bunch of container ships and they sell long-term charters to their vessels to a range of liner companies. So they're kind of the back end of container ship transport, I guess. They buy them, they build them, they buy them, they operate them, and then they lease them out. Long-term charters, mostly. There's a few short-terms and bareboats things, but it's mostly long-terms. According to their recent 20F filing, and for Australian listeners, that is sort of the equivalent of an annual report for foreign listed companies in the US. They issue a 20F. As of February 28th, 2025, Danaos had a fleet of 74 container ships aggregating 471,477 TEUs and 15 under construction container ships, aggregating 128,220 TEUs, which makes them one of the largest container ship charter owners in the world based on total TEU capacity. Tell everybody what TEU stands for, Tony.
I did know it. Use for unit. It's basically the cargo box size.
The Ray knows by now, after working with me for 15 years, that if there's an acronym,
quicker. Yeah.
If there's an acronym that's going to be used in the show, be prepared, because he knows I'm going to throw it to him to see if he can Google it quicker. It stands for 20-foot equivalent unit. I had to look it up. I didn't know what it was. 20-foot equivalent unit. It's a standard unit of measurement in shipping to describe the capacity of container ships and container terminals. One TEU is one standard 20-foot long shipping container. The shipping container in imperial is 20 feet by 8 feet wide by 8.5 feet tall. In metric, that's a little bit over 6 meters long, 2.43 meters wide, and 2.59 meters tall. A 40-foot container is 2 TEUs. So a container ship fleet like these guys contains about, as I said before, 74 container ships all up. 53 container ships are deployed on time charters, and they have 2 container ships deployed on bareboat charter, and the rest are on shorter term leases. A bareboat charter, for people like me who don't know what that is when you charter out a ship with nothing on it, no crew, no supplies, no maintenance, basically just an empty ship, and the charterer is fully responsible for everything: hiring the crew, operating the vessel, maintaining it, insuring it, fueling it, handling the paperwork, the whole kit and caboodle. So the company's headquarters are in Piraeus, Greece, the main harbour of Athens. You and I have been to Athens. Separately. But you bowed out of our European tour when I took a bunch of people to Athens. But Piraeus, I got mugged? Not mugged. I got pickpocketed in Athens. Must have been the most disappointing pickpocketing of their lives, those guys. They spent half an hour picking my pocket to get like €70 or something. The Piraeus is the main port of Athens, and it has been since the 5th century BCE. I talked about it a lot on my Alexander the Great series. Piraeus played a big role in the various revolutions that Athens had back in the day, in the good old days. The company is named after Danaos, the Greek mythological figure who was the king of Libya in Greek mythology. His identical twin brother was Aegyptus, the king of Egypt. And if you remember your Greek mythology, Tony, Danaos had 50 daughters and Aegyptus had 50 sons, about half as good as Elon Musk. Stories now are starting to emerge that say that Elon Musk has got 100 children. Have you seen those?
No.
Getting his sperm out there, doing its job, because he wants the world.
When he walks back his involvement with the US government, do you think he'll have time for Tesla still, or is he going to go and size some more kids?
Oh, I don't think he's personally involved in siring the kids most times. It's mail order, I think. Just sending his sperm out via probably a drone that lands on them.
Electric drone.
Anyway, Aegyptus wanted to marry his sons to Danaos's daughters, and Danaos's daughters.
And yeah, he had 50, and the other guy had 50. Yeah. Well,
yeah, and a little bit of inbreeding never did anyone any harm. But Danaos's daughters didn't want to marry the sons, so Danaos made the very first ship in history He invented shipping, Danaos, according to Greek mythology. And he and his daughters all escaped. But then they figured out there was going to be a war. So they went back, and the daughters all married the men and then murdered all of them. Well, 49 of them murdered their husbands in the middle of the night, chopped their heads off and buried them. And one refused to because he was nice to her. And that's a whole other story. But anyway, so the point of all of that is Danaos built the very first ship.
What was that first cruise ship called? It wasn't the P&O Oriana, was it, with 50 dogs?
There's the Love Boat. That's what it was.
The Love Boat.
Yeah. So anywho, the company was founded by Dimitris Koustas in 1963 when he bought his first ship. And he ran it for a very long time, just built and consolidated and built. And they floated, I think, in the 80s or something like that. But the company's doing very well. As I said before, they've got 73, 74 ships, most of which are in fixed time charters, which might help their revenues in the short term, depending on how many of the companies that have those want to renegotiate or go out of business, depending on whether or not there even are any tariffs a month from now. Who the hell knows whether there will be or won't be. But breaking it down, the sort of factors that affect their revenues are the number of vessels in operation in their fleet. Some are obviously, they're not all operational all of the time. Some are out for maintenance and those sorts of things. The charter rates, how well they can sell them and keep them actively employed. The utilization of the fleet and their expenses, keeping their expenses down as much as possible. Now, they seem to run a pretty tight ship. However, side note, when I was researching them, about a year ago, one of their ships was banned from Australia for 3 months for being unseaworthy. A little bit before that, they had another ship, the Suez Canal, that was subject to a prolonged detention by the Australian Maritime Safety Authority. This is in January 2004. For not being in good condition either. The second one that was banned was called Peace. And Mr. Witherell, who was a representative of the Maritime Safety Authority here, said, the state of peace was so poor, could have been talking about, I don't know, just the world right now, was so poor that it represented a very real and unacceptable risk to the safety of seafarers on board and Australia's marine environment. Ships cannot be operated in this unseaworthy state. Allowing a ship to fall into a state of deterioration is completely unacceptable. There are no excuses for this level of neglect. That is why we have taken the next step of banning this ship from entering an Australian port again for 3 months. Further action may be taken against the company itself should Danaos Shipping continue down this trajectory of operating unseaworthy ships. So he did not hold back, Mr. Witherell. Anyway, that was the only negative news I could find about them and their unseaworthy ships. Mr. Witherell,
well, hopefully
scathing.
They've learnt their lesson and they're all completely seaworthy now.
Now, obviously, drilling down into I said we don't predict, we don't project, but there obviously are a lot of things that, with tariffs that could impact shipping businesses and container businesses that, as I said earlier, have already had sort of a rough run. There you had the first Trump trade war with China in his first administration. That sort of continued to some degree during the Biden administration. We had the Ukraine war still going on. We had issues in Israel and the Red Sea and the Houthis, and there's been tensions affecting global supply issues. And of course, Trump's tariffs are going to make imported goods into the US more expensive. or just be less of them if people just stop buying it into the company, which means container shipping companies are going to be in the hot zone for that. They're going to have less business, or the people chartering their ships are going to have less need for their ships. There could be flow-on effects for companies like Danaos. They do mostly have long-term contracts now, but everything is up for negotiation, and people try and get out of contracts, obviously, when times get tough, and all those companies just go belly up or go bankrupt or whatever, and that can affect their revenues. And then even if they don't do that, it might mean if this tariff war and this decoupling of the West and China continues, that when those long-term charters are up for renegotiation, they may be at lower rates, there may be fewer of them. I guess the other difficulty for this company might be that if it's already got 15 ships under construction out of China, I believe, you can end up with too many ships, not enough charter contracts, not enough cargo for the ships. Ships could get idled or scrapped. There's a whole bunch of things. And back in Trump's first term, global container shipping rates did fall. Companies saw lower rechartering rates, reduced volumes, higher idle fleet percentages. So there could be some heavy wins coming for these guys. That said, I ignored all of that when I bought them the other day, because it might happen, it might not happen. Trump's tariffs could all disappear tomorrow. Who knows?
Well, there's that, but there's also, all that stuff's baked into the share price, and we track the sentiment, and we've calculated our price to get out. So if any or all of those things come to pass, it'll be reflected in the share price, and the share price will fall below our trigger and we'll sell. So
yeah, exactly.
That's how we deal with predictions. But I mean, it's a good summary of what's going on. I mean, we're seeing, as we've said before, a decoupling of international trade. So that's got to, you would think, affect these kinds of companies. But given that they're on our valued buy list, it's probably factored into the share price.
Yeah. Yeah, and I think, that's one of the reasons we have a lot of shipping companies on our buy list, is they're facing some challenges, and they're not the sexy kids on the block, but that's when we like them, right? Particularly if they're making money.
Sexy kids are expensive.
You should know.
We'll take the Greek kid. One
with the monobrow.
The one with the ships. The one with the ships.
So look, the business has been doing quite well. If I look at the total revenue line, I'm in Stockopedia now. Total revenue over the last 5 years. So from 2019, they did $447 million in revenue. Went up to 462 in 2020, 690 in 2021, 993 in 2022. Dipped a little bit in 2023, 974. 2024 went up over $1 billion, $1 billion and 14 million. The projections for 2025 is around about $1.046 billion. And then the projections for 2026 actually dip a little bit. But they've had great growth over the last 5 years. They've more than doubled their revenue over 5 years. Their operating profit has followed a similar sort of trajectory, 201 million in 2019, up to 541 million in 2024. That's their operating profit. The net profit has gone from 131 million in 2019 to 505 million in 2024. Did go up over $1 billion in 2021, which is insane, from 131 to $1 billion. But I assume, there was a lot of ships that were being built at various stages there.
Well, in COVID. So you're making a good point,
right?
As you said before, that the world would have been pulling its hair out during COVID about what was going to happen to shipping companies. But these guys who've seen it all before and been through downturns in the industry have been able to manage their way through and survive and prosper. And, that's one of the benefits of the quality side of the QAV methodology. We're trying to find people who've been around a long time and have been through cycles and know how to manage their way through downturns. If one should come. Yeah.
Their earnings per share has also gone from about $8 in 2019 up to $26 in 2024. Again, like their net profit, as you would expect, it sort of spiked a lot higher. 2021 came down, 2022, 2023. But, it's come a long way in the last 5 years. Their operating margins have gone up a little bit, 45% from 2019 to 53% today. The dividend per share was nothing back in sort of the COVID era, but is now looking at, last year it was $3.25. The forecast for this year is $3.40. Cash on the balance sheet has gone from 139 million in 2019 up to 514 million in 2024. Like every metric that I looked at and ran through a checklist looked pretty good. I've got the checklist here. I'll go through the scoring. For a start, their average daily trade is little over 8.5 million. So for the US, that's a small company. For us here in Australia, that's a very large average daily trade. Their quality rank on Stockopedia is 78, which is pretty strong. I scored them a 1 for quality rank. I scored them a 1 for their stock rank. I scored them a 1 for their F score, a -1 for their Z score, penalised them on the Z score, but it didn't really make much of a difference. Their price...
I thought we were taking Z-score out of the checklist. Didn't we have that discussion?
I decided to penalise companies if they had a bad Z score. So they get a -1, sort of a slight tempering of financial health. But, if everything else is good, a negative Z score doesn't really seem to make much of a difference on the overall score. Their price is below our first intrinsic value metric. It's also below our second intrinsic value metric, our IV1 and our IV2. It's also below book plus 30. They do have a positive uptrend, so they got a score for that. Don't have a new 3-point upturn. Growth over PE is not greater than 1.5, so I couldn't score them for that. But their book value growth is positive. Their PE isn't less than the yield. The yield isn't higher than the bank debt. Their forecast IV is not great, is greater than twice the share price, so I scored them for that. Their price to operating cash flow obviously is less than 7, whether I use our number or the Stockopedia number, so they got a score for that. So they ended up getting a quality score of 79%, which is pretty good. And then their QAV score was 0.33. They weren't at the top of the buy list, however, but I did a buy list on Friday our time, I think it was. And then I sat down over the weekend I sat down like on Saturday to buy some stuff to get ready for when the markets reopened. And a lot of stuff had dipped. We're having down days on the Friday. A lot of stocks had a hit. So a lot of the stocks that were higher than them on the buy list, I couldn't actually buy. I had to go down. They were like number 10 position on my buy list. I had to go down quite low to find something that was still a buy after 24 hours had passed. But that's Danaos Corporation, Tony, Greek shipping magnates.
I had a couple of things. Just I had a quick look at it when you said you were going to talk about it today. They do have an owner-founder, which you spoke about before. or at least it's a relative or the son of the founder, Dr. Kustas, and I think I've pronounced that properly. And the company, the family is still a 47% shareholder, so we would call them for an owner-founder as well.
Which
Couple of other things I noticed, they are buying back their shares, and they've recently announced they're going to do that at a faster rate. So they've increased their buyback, which is not part of our checklist, but I wouldn't be surprised if putting buybacks into our checklist becomes a thing sometime in our near future. We have had this question raised on the QAV show in Australia before, as we use operating cash flow. Why not free cash flow? So free cash flow for this company was negative in this half. And that was basically, as you said before, they're building lots of ships. So they have a big CapEx bill this half. But if you look at the trend of CapEx expenditure in Stockopedia, it's a one-off expense. So I tend to focus on operating cash flow for that reason. It's, whether they decide to use that cash flow for building ships or doing buybacks or whatever else is up to them. And, we're trusting in their good management. They've been around a long time doing this. So I'm not going to begrudge them a bit of CapEx spend this year. And then the last thing I'll say is they're getting pretty close to their sell price. So people should be aware of that. And, obviously we're not recommending this company. You have to go off and do your own research and have a look at it. But, we look at sentiment, and it's getting pretty close to its sell price based on that. Current stock price is about 1% above our sell price.
Yeah, and from memory, I don't have the chart open in front of me, but it was just above its buy line as well, I think. Is that right?
Buy price, no, it's a fair bit above the buy line. The buy price is $69 and change, and they're just under $80 now. And the sell price is $79.32, so they're about 60 cents above their sell price, but $10 above their buy price.
Let me just bring up my chart and bread later. DAC.
So for new US listeners, when we refer to the Brettolator, it's a tool we use to chart sentiment, and it gives us a buy price and a sell price that we use before we make a purchase or make a sale.
Right. Okay. So, yeah. Okay. So they've just gone, like the share price just went up recently and got it just above the sell line. So that's what I was thinking. It's a little bit above, it went above its buy line, looks like back at the beginning of the year, but it's just above the sell line, which is why it's a buy. So it could go either way. It could keep going up.
Yeah.
But the sell line's going up pretty steeply as well.
Yeah.
But that's going to change. So it's L1 is July 2020. So there's another one there in October. Yeah. Its sell line's going to become a lot less steep, I think, once we get through the next couple of months. But that one in October won't change it dramatically. Anyway.
Yeah.
If it becomes a sell, it becomes a sell.
Correct.
C'est la vie. Anyway, thank you for that. Additional
Yeah, thank you.
stuff. DAC, Danaos. Well, that's all I've got for the show, Tony. You got anything else to talk about?
I have not, no. People I'm sure, are glued to their Wall Street journals and their Fox News and CNN or whatever, finding out what's happening in the market, but we just treat that as noise.
Yeah, ignore the noise, focus on what's real, which is the numbers, the cash.
Correct.
If you have any questions, if you're a US listener and you have any questions, feel free to shoot me an email, just cr@qavpodcast.com.au. Maybe .com too. I think I own .com. Just cr@qavpodcast.com should get to me. If you do send that and I never reply, then maybe it didn't. But you can also join our Facebook group. You can get us there. If you have any questions about QAV or how it works or what we're doing in the US market, feel free to reach out and throw us a question that we can either answer on the show or privately. It's up to you. And we will be back soon with another US show. Thank you, TK.
Thanks, Cam. And happy NYSX, NYSE.
NYSE. Happy Nissy.
Yeah. Happiness.